So China's home prices are now at a decade low. In real terms, they've fallen back to around 2006 levels, which is 20 years back. And even in nominal terms, they're now at roughly 2016 levels. Now, this is another sign that the country's property crisis is far from over.
That's not an exaggeration, and it's not even the worst part. When you actually dig into the newest numbers, the picture is more severe than most headlines are letting on. So today I want to break down exactly what's happening, why it's happening on purpose in some ways, what it means for the rest of the world, including us here in the US, and I'll give you my honest take on all of it too. Before we get into it, 4 things are happening in China's economy at the exact same time right now. Home prices are down close to 49% from their 2016 peak, according to Global Property Guides Index. Real estate investment just fell 18% year over year, according to China's own government data released this month. China's overall GDP growth just slowed to 4.3%, the weakest pace since the pandemic. And youth unemployment for people aged 16 to 24 is sitting at 16.3%. These 4 things are connected, and by the end of this video, you'll understand exactly how. Let's start with why real estate ever got this big in China in the first place. For 2 decades, property wasn't just a place to live, it was basically the entire financial system for the average family. Chinese households put nearly 70% of their wealth into housing, compared to less than 10% in equities. With a stock market people didn't trust and almost no other place to grow their savings, buying an apartment became the default, not an investment, the investment. And for a long time, that bet paid off enormously. Real estate and everything tied to it grew to account for close to a third of China's entire economic demand, according to Harvard economist Kenneth Rogoff's research with the IMF's Yuan Chenyang.
What the real estate boom and bust episode in China has looked like?
Well, real estate has been the cornerstone of the Chinese growth model. And if you include infrastructure, which is closely related, it accounts for roughly a third of demand in China over a very long period.
To put how extreme that got in perspective, their research found China's investment rate stood at 40% of GDP for 2 straight decades, a level so extreme it's second only to Iceland right before Iceland's own financial collapse. Developers borrowed to build, local governments sold land for revenue, banks kept lending, and prices kept climbing. Then in 2020, Beijing made a choice. Not a mistake, a choice. They introduced new lending restrictions that cut off the easy financing developers had relied on for years. And this is where you have to understand something important. This wasn't an accident that snuck up on anyone. China's own president recently said the global system itself is weakening as conflicts intensify, and inside China specifically, the government looked at a real estate sector that had grown too large, too leveraged, and too dangerous, and they deliberately let the air out. Evergrande collapsed under roughly $300 billion in debt. Country Garden, once the country's largest home builder, defaulted on its bonds not long after. And because so many buyers had already prepaid for apartments that weren't finished yet, people ended up making mortgage payments on buildings that might never get completed. Here's where the newest data gets genuinely alarming. China's own National Bureau of Statistics released numbers this month covering January through June of 2026, and real estate investment is down 18% year over year. New construction starts are down 23.4%. This isn't old crisis data from 2021 or 2022. This is happening right now, this year, and it's still getting worse on the investment and construction side, even in places where prices themselves have started to stabilize a little. That last point actually matters because the story isn't as simple as everything keeps crashing every month. If you look at the actual monthly price data, the year-over-year decline in newly built home prices got as bad as negative 3.5% around March of this year, and it's actually curved back up slightly since then, closer to negative 3.1% by June. So prices are still falling, real wealth has genuinely been destroyed, but the pace of new damage on the price side has been easing for a few months now. Construction and investment, though, are still falling hard, which tells you the physical building side of this crisis hasn't caught up to whatever stabilization is happening in prices yet. Now here's a comparison I think most people miss entirely. Rogoff and Yang's research directly compares this to Japan's real estate crash in the 1990s, and they found something that surprised even them. China doesn't actually have the same kind of banking overexposure that caused Japan's crisis to drag on for 2 decades. China has a high savings rate, and the state has enormous ability to step in and manage debt directly. So why is this still such a big problem? Because the real damage isn't really about banks defaulting, it's about how people feel. When 70% of your wealth is tied to an asset that's down 49% from its peak, you don't need a banking collapse to feel poor, you just stop spending. Rogoff's research actually quantifies this exact effect and found it was just as important in Japan's crisis as it is in China's right now. And that wealth effect is already showing up in the labor market. Youth unemployment for the 16 to 24 age group is sitting at 16.3% this year. A record 12.7 million university graduates are entering the job market this summer into an economy where the sector that used to soak up huge amounts of labor is actively shrinking. Here's the part I actually want to give you my honest opinion on because I don't think this is just a China story, even though the mechanics are different here. I think the real lesson from all of this isn't about real estate specifically, it's about concentration. An entire country put the overwhelming majority of its wealth into one single asset because for decades everyone assumed the price could only go up. And I see that exact same mindset here constantly. People with almost everything riding on one house, one stock, one company, not because they've actually sat down and weighed the real risk, just because it's worked out fine so far. If your entire financial life is tied to one thing going up forever, you're not really investing at that point, you're just hoping. There's also a piece of this that goes way beyond China's own borders, and I think it's genuinely underappreciated. Desmond Shum, who used to be a real estate developer in China himself before writing about it, put it well recently. He pointed out that China's property bust isn't just a domestic balance sheet problem anymore, it's becoming a global manufacturing shock. Because when the property machine that used to absorb Chinese savings, bank credit, and local government ambition breaks down, that capital doesn't just disappear, it gets redirected. Beijing is now pushing hard into manufacturing instead EVs, batteries, solar, chips, robotics. Since the start of 2025, roughly 95% of newly listed companies on Chinese exchanges have been manufacturing related. So the excess capacity that used to go into empty apartment towers is now going into factories that are going to be exporting into the rest of the world, which is exactly why S&P Global's analysts called this downturn so entrenched that only the government has capacity to absorb the excess inventory. So the obvious question is, could something like this happen here in the US? Honestly, the mechanics are different enough that I don't think we're looking at a China-style collapse. Americans hold roughly a quarter of their wealth in real estate, not 70%. Most homeowners are sitting on fixed-rate mortgages locked in years ago, not variable debt tied to unfinished pre-sold apartments. Nobody here is being forced to sell the way developers in China were. But here's the analogy I keep coming back to. Think about a company employee who puts every single dollar of their retirement savings into their own employer's stock, because it's done well for a decade and they trust the company completely. That's not diversification, that's a bet dressed up as a plan. China essentially did that at a national scale with real estate, and plenty of individual investors, here and everywhere else, are quietly doing the same thing right now with a single stock or a single property, just on a smaller scale. One more thing worth sitting with before we wrap up. Markets don't find a bottom just because it feels overdue. Reuters polled analysts back in March, and they still expect Chinese home prices to fall another few percent before any real stabilization shows up in 2027. If an entire government with trillions of yuan in support programs, a whitelist mechanism that's already approved over 7 trillion yuan in financing for stalled projects, and basically unlimited administrative power still can't call the exact bottom, neither can you or I in any market. So here's my actual takeaway from all of this. This was never really a China problem or a US problem, it's a concentration problem. If one single thing you owned dropped 30% tomorrow, would the rest of your financial life still be standing? If the answer is no, that's worth fixing now, regardless of what happens on the other side of the world. Let me know in the comments, do you think something like this could ever actually happen here? Or is our market just built too differently for it to matter? Alright, that's it for this one. Thanks for watching, and I'll see you in the next video.